Commissioner Stephanie Garcia Richard.
Here.
Treasurer Laura Montoya. CFA Secretary Wayne Probst. Nick Tejas. Catherine Allen. John Bingaman.
Present.
Kelly O'Donnell.
Present.
Alan Sanchez.
Present.
Kurt Sommer.
Present.
Governor, we have a quorum.
Okay, great. Well, good morning, everyone, again. Why don't we go to that matter of business where we approve the agenda, which was provided to folks in advance. Do I have a motion to approve?
So moved.
Thank you, Kelly. Do I have a second?
Second.
Awesome. All those in favor say aye. Aye. Aye.
Aye.
Any opposed? Assuming we have no questions? All right, and for people watching, if we had questions, we would have gotten them a bit ahead of time. So it's an easy one to move through as long as something hasn't arisen. With that, the next item for opening matters is item 1C, which is approval of the State Investment Council meetings from May 28, 2024. Can I get a motion to approve? So, thank you, Member O'Donnell. Do we have a second?
Second.
All right, thank you very much. Any questions, comments, statements, concerns? Seeing and hearing none. All those in favor say aye.
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 Hearing no opposition, the minutes of May 28, 2024 are approved. We are on item number 2, or section number 2 of the agenda. It's the investment activity, performance, and capital market update. And we'll start with John Clark.
Thank you, Madam Governor and members of the council. As of May, the total distributions for the last 12 months were $1.6 billion. Just to remind the council, our projections for total distributions for fiscal year 2025 will be about $2 billion. That's a significant amount of money we're going to be giving back to the state. I think a lot of New Mexicans, and including a lot of legislators, aren't aware that SIC is already starting to generate significant funds that go back to the state each year. So one of my goals is to start promoting the benefits that SIC is already providing to the state. As part of that, I'm going to be presenting to IPOC, the Investment Pensions and Oversight Committee, on Monday, covering a lot of general stuff about SIC with them, but also making them aware of what an important role SIC is already playing in their annual budget making ability. Our net asset value as of a week ago was $54.2 billion, up from about $53.5 billion last meeting. The New Mexico WTI oil price as of Friday was $78.77. This is up from $70.14 a year ago. Rig counts are also up to 108 rigs on Friday from 106 a year ago. Natural gas is also up a little bit to $2.71 per MCF versus $2.60 per MCF a year ago. So everything is looking good for both our inputs and our distribution. I mentioned in the last meeting that Nicole Gallegos, who had served with SIC for 18 years, leading up the accounting team under Brent, our CFO, was retiring. And we sorely missed her, but luckily 2 rigs who had been working under her has stepped up into that position and has taken on now the lead of the accounting team. So we're really grateful to 2 for taking on that important challenge for our agency. And we're working on filling the remaining vacancy left behind in that important team. I really want to thank 2 and the entire accounting team and all of Brent's support for that team as they go through this change, because it has been a long time since we've had turnover at the top of the accounting team, and they work extremely hard. So thank you very much to them. Coming up in FY25, we're going to be receiving some additional positions. One will be an investment operations manager. another is a cash manager, and then we're going to be hiring 3 analysts. Apart from that, we also have one new hire, Giselle Jacobs. She's our new HR manager. We've never had an HR manager before, but as we grow, it became apparent that that was something we needed to bring into the office, and she has hit the ground running and has just been fantastic so far. So really glad to have her on the team and as part of the upper management team. Apart from that, the governance committee did meet. Governance Committee Chair Catherine Allen was not able to be here today, so we're going to ask her to give an update on what happened with the Governance Committee meeting at the next council update. But in brief, the Governance Committee discussed a lot of matters about essentially how to, from an organizational perspective, really make SIC a world-class organization in terms of governance structure. And I think there was a lot of great discussion among the committee members, and it gave us a lot that we need to go back and work on and come back to the committee with, and then later to the council. So looking forward to that. We are also very close to finalizing dates for the strategic planning retreat and hope to have that finalized this week and sent out to everyone. One other important issue raised by Catherine Allen was that part of the charter for the governance committee is that that committee should be in charge of promoting educational opportunities for the council. And so she asked us to poll all of you as council members what educational opportunities you would like. What would you like us to do? We're happy to bring in outside experts, provide you education on any variety of subjects that you would want. And so at her request, we sent out this poll. If you get a chance, please respond so that we know what you would like to see. We will also soon be sending out a poll to council members as soon as we have the dates finalized for the strategic planning retreat on what you want to see in that strategic planning retreat. We have a few ideas, but this is your retreat, and we want to make sure that what you want to see in there gets on that agenda. And with that, Madam Governor, I'm happy to answer any questions.
Thank you very much for your report. Do any of the council members have any questions on this? All right. Then we won't move on. Thank you. We're going to go to our CIO briefing. Mr. Smith?
Thank you, Madam Chair. Good morning, everyone. Economic statistics are starting to become a little more choppy, though still steady, or still moving us forward. Job numbers are being reported solid and at pretty solid rates, and then generally being revised down afterwards. That happens when things start to weaken a little bit. The beginning of some weakness in housing. We're seeing starts down, new home sales and existing home sales under a little bit of pressure. That's usually an early sign of a little more choppiness in the overall economy. Consumer credit is given the feel of some toppiness here, so we're kind of keeping our eye on that. The last Fed briefing indicated just one rate cut this year. As you recall, at the beginning of the year, 6 or 7 were forecasted. It's down to just one, according to the Fed at their last briefing. Economically, that doesn't really mean much. It's 25 basis points on a base of 5.25 to 5.50. So not a great decline in that. And it does leave rates still a little bit restrictive. So the trend growth in the U.S. economy is about 2% per year real. You had 3% inflation, which is about a run rate today, gets you to 5, and Fed funds is 5.25 to 5.5. So Fed funds above nominal GDP is generally a restrictive interest rate policy. Also, the Fed balance sheet is still declining. We're down close to 7, just a little bit, maybe 7.2 trillion, down from a 9 trillion peak. Although that number really, based on the size of the economy, maybe 2 or 3 trillion is right. So we've got another 3 or 4 trillion for the economy through the financial markets to absorb from the Fed's balance sheet. So more restriction coming from that for that side also. We've talked a little bit about inflation. That when we do get bouts of inflation like we had, it tends to come in 2 waves. So we get that initial wave, central banks respond, inflation comes down, but then we get another wave. That's been true across countries and across time for quite some time. So I think that's probably why the Fed's being a little bit restricted now, being a little bit tight-fisted with rates, and also continuing to decline that balance sheet is perhaps fear of that second wave. So kind of keeping our eye on that. I think it's about all from the economic front or the environment that we're in. We've got a solid agenda for you today, so you'll be able to review the returns that we've been able to generate within the environment that we talk about each month. So lots of reports there, and then 3 voting items, a little bit of asset allocation work, plus 2 new investments in the private space. And for you, Madam Chair.
Thank you very much. Do we have any comments or questions by council members? All right. Hearing and seeing none, we'll move on. We're going to do the performance report by both Smith and RBK.
Yeah, well, let me turn right to RBK for their comments on the broad performance report.
Thank you, Madam Governor. Good morning, everyone, and thanks for the introduction. Great summary of the economic environment. You have the April performance summary in your packet, starting on page 17. Brief review of the capital market environment, particularly as it relates to the numbers that you're seeing in that report. This one-pager is a good summary of what transpired over the shorter and more intermediate time period. I think if you're looking at the bottom right-hand side of market performance table, you can see that both equities and fixed income struggled in this month, in particular as inflation has continued to be persistent, more persistent than perhaps desired or expected. So that's continued to increase market speculation, as Vincent indicated, that we might not see as many rate cuts as previously communicated. A lot of the market really been hoping for these rate cuts to come through, but the data just really isn't there. And as we've gone through that past April, that in fact has been the case. We haven't seen any rate cuts, and those projections continue to get pushed out, and it's at 1 now, but frankly, it wouldn't be surprised if we stay on this trend line and we won't see any for the rest of the year. And that's, I think that's probably not going to be too surprising overall. When you're looking at these negative returns under the month-to-date column, you'll notice that U.S. markets really underperformed international. That's bit of a change in terms of market leadership. Emerging markets be able to provide some modest gains, at least on an index basis. And as I mentioned, fixed income struggled here as well, down 2.5% or so. A lot of that coming through because of the increase in yield. You can see that in the top right-hand side of the yield curve. Yield really shifting up as the reality of no interest rate cuts coming our way in the immediate future, I think, setting into that market as well. You could get lower rates if we have a recession. It could also stay higher for longer if the wage growth remains resilient and continue to see strong indicators, essentially, out of the economy. So it will be interesting to see how the next 6 months materialize. The diversification that you have built into the portfolio is going to serve quite well. You have cash, as Vince was mentioning, that's yielding still above 5% across most cash and cash equivalent markets, and with inflation being higher than 2% Fed target, but certainly below that 5%, is getting positive real yield, and that's taking some pressure out of the inflows that are coming in and needing to rebalance those into the broad asset allocation. So stop here. Happy to take any questions or comments. I'm going to walk you through some of the performance figures.
Are there any questions so far? Hands up. All right, Marcia.
Thank you. Governor, nice to see you again. Sorry about all the difficulties we had in following it.
I appreciate that. For me, it's very little. I saw those men and women on the ground and people who have incredible losses.
Well, we're thinking about your case. I'm going to take you to page 19, and it's before we get to the performance, just a couple comments on the asset allocation. Again, the allocations that we're showing are the interim targets. As you know, it takes a while to get money in. You can commit, but you get money called into the private, so there are interim targets for both the land grant and the severance tax. You can see underweight, or on the privates, it takes a while to build up. At the last meeting, one of the council members asked about minimum and maximum targets, I think specifically for public fixed income or public. Back in 2022, because of the markets and because cash was actually starting to pay money, and because of it takes a while to get privates funded, some of the targets were suspended, as an example, for public fixed income, and then asked what the minimum and maximum was for that asset class at that time, and the minimum was 6% and the maximum 14%. Since then, there's been an allocation change, but again, those are the numbers that I didn't have in front of me at the last meeting. Looking at performance, as Mattia said, it was a very difficult month. The month of April, before the total assets were down 1.55% for the month. Land grant did a little bit better, but trailed their benchmark for the month, and severance did a little worse and trailed their benchmark. But that is for a month, and this is an interim. This is a monthly report and not a quarterly report, so things like private assets aren't factored into that return. So looking at the longer-term return, fiscal year to date, which is 10 months, and 1 year, still not long-term, you can see the outperformance actually for both the land grant and severance tax. And looking longer-term beyond that, you can see the land grant has outperformed its policy benchmark for the time period shown. On the following two pages, pages 20 and 21, again, shows the allocation versus target for each of the funds. Just mentioned here that beyond the land grant and the severance, tax stabilization has an interim target in early childhood. The rest do not have interim targets, so it's just the target stated as their long-term target. Thought it was interesting on page 22 and 23, we look at calendar year to date, your beginning value, your ending value, cash flows, and gains, losses. Wanted to point out on page 22, the tax stabilization fund. This is the only fund you have that does not have equities. It has short duration, fixed income, public fixed income, private fixed income, and real estate. And you can see that it has actually a loss. Again, no public equities for that calendar year period. And as Mattia showed, fixed income has been it's been a difficult period for fixed income as well. So a negative return for tax stabilization. Beyond that, you can see that there's positive returns for each of the funds. Page 25 looks at your composite performance. It shows land grant and severance, but we reviewed that. Looking at your composites or your asset class returns, U.S. equity trailed for the month, but for the fiscal year to date and calendar year, 12 months trailing, nice outperformance against its benchmark. The longer term it trailed, but there was a change in structure to that asset class, so it was nice to see fiscal year to date and 1 year numbers well ahead of their benchmark. Non-U.S., your institute did an asset class review a couple months ago, and some changes coming there, actually an RFP, again, trailed for the month, calendar year to date ahead, and longer term ahead of its benchmark. On the fixed income side, public fixed income, as Mattia mentioned, been a difficult market for public fixed income, but you'll notice that you outperformed your aggregate benchmark across the board. Having exposure to short duration assets in this time was very beneficial to you, so you outperformed. On private, you can see that you underperformed. Again, that portfolio is being restructured and built out. There was a benchmark change. So you can see trailing there, but I would just need to stay patient, but also look at the returns compared to the public market. So having private fixed income has been very beneficial to you to outperform public markets. And then cash again is returning assets. On the following page, providing a return of 5%. On the following page, again, this is a monthly report, so we don't have privates, but I do want to point out that now, again, we're showing the private equity composite, ex-state investments, and then we do have the severance tax state program and the ECI program as well. Remembering again that this is time-weighted returns, not IRRs. Your managers will be going over the more relevant returns. But if you look long-term, it does kind of weigh out over time, and you can see your national program for the 3-year period, that's 13.8, and also underperformance or negative returns for the severance tax and economically targeted investments. And again, you've been doing a lot of work on the state, so hopefully we'll see those numbers change and become positive. With that said, it's a monthly report. I know you have a lot of other reports. We're happy to ask any questions. I'm happy to go through every page of this, but I think I hit the highlights, and I'm happy to answer any questions.
I do appreciate the clarification about quarterly versus monthly and hitting targets and projections. Does anybody else have any questions or comments? All right, and welcome, Secretary Fox.
You're not coming back.
We were going to move you, but I insisted that you be there. It's going to get you to talk more. We call him the Secretary of Silence. All right, well, thank you very much. You're welcome, Secretary. Let's go to the next report. We are on item 2D for the agenda, and that is the Quarter 4 2023 private debt ER. And we've got Tom Lofton and Makita. I'll see you.
Very serious.
Because they're behind me. See, again, when you don't have people where they go, I can't find anyone.
My colleague, actually, Kat Ferguson, is going to present this remotely.
Okay.
And Tom, I'm happy to.
Good morning, Tad Ferguson from Makita. I couldn't quite hear the intro there. I wasn't sure if you're ready for me or not. But I will just dive in. Can everyone hear me okay?
Yes.
We can.
Okay. Apologize for being on Zoom, but hopefully this works out okay. As mentioned, presenting the private credit performance report. And as a reminder, private market managers provide their information on a lag basis, and that can be particularly delayed at year end due to the underlying auditing process. So we are presenting the year end performance report in June, but we will be back in August with the Q1 performance report. But overall, the private credit program is a program that is undergoing an evolution and restructuring. So I will kind of try and focus my comments towards those activities and be overall relatively brief in the summary comments. But we'll dive in on page 48 for the overview comments. As of year end 2023, the program was constructed with $7.6 billion of commitments committed across 50 underlying partnerships. The program had a remaining market value of $3.1 billion as of year end. This represented about 6.2% of the total portfolio, and that has declined from slightly over 10% the prior year. And much of that is due to the restructuring activities, as there's some liquidation of underlying holdings and transfers of assets, and then combining that with strong total portfolio growth has really resulted in an underweight to the private credit asset class. And while I'll expand upon this throughout the report, there are material commitment activities on a go-forward basis to reach and maintain that target allocation over the long term. It is currently underweight. As of year end, the program generated a net since inception internal rate of return of 5.6%, and this outperformed the policy benchmark of a leveraged loan index plus 200 basis points using a public market equivalent calculation, outperformed by 20 basis points since inception. And given the restructuring, we also provide the calculation on this page of the IRR X legacy and liquidating. And these are exposures that were in the portfolio that were not part of the prioritized go-forward exposures. They had different roles in the portfolio, not necessarily underperforming, but just didn't fit the go-forward strategy. So we perform a calculation of looking at the results of the 4 core strategies going forward, and those have generated a 9.1%, very strong results, and again, outperformed the public market equivalent of the policy benchmark. On page 49, a little bit more detail on the strategy exposures as part of the restructuring. We have 4 go-forward strategies for the private credit portfolio. This includes direct lending, asset-based, special situations, and diversifying. The legacy and liquidating are the ones that are going away. The direct lending and special situations are at or near term the target ranges that have been proposed for the asset class. Asset-based is underweight, and the diversifying class is currently overweight in these targets. And these are evolving, as I say, part of the restructuring. There's a lot of moving parts with this. But subsequent to the 2023 fixed income structure review, private real estate credit has been added to the mandate, and there will be real assets credit partnerships that will be folded into the program. So we will be working with the Director Lofton to revisit these strategy allocations to reflect this, and that'll impact that diversifying category that is currently overweight.
And just to interrupt.
Yes.
Oh, sorry, Jen, just for a quick, just so the trustees are aware, currently the real estate debt component is under the diversifying, which is one of the reasons why that is significantly elevated relative to the policy target. So that's something that we're going to be working through with Director Lofton on a go-forward basis.
And just to highlight the evolution of the program, the liquidated and legacy exposures represent just under 7% currently, but just 6 months prior, these exposures represented almost 38% of the total market value. So just want to, kind of put in perspective how much the program has changed over just a 6-month period. Just moving forward a couple of slides to page 51. As I mentioned, the program is underweight. There'll be, require material commitment activity going forward. Just on 51 really kind of graphically portrays a more consistent commitment activity to the private credit assets space. While there is some quarter-over-quarter variability in the amounts, this just really kind of graphically shows a really consistent commitment activity that we expect to maintain and strive to get to the longer-term target allocation. And on page 52, a little bit more detail on actual commitment activity over recent periods. In the 2023 calendar year, there was 1.7 billion of commitments, and that was up significantly from 2022. And we've included year-to-date activity for 2024, which is already at 1.25 billion. And the commitment activity year-to-date is a combination of some new managers and relationships, larger commitments, but also upsizing prior commitments that were still available to take additional commitments, just to better position and appropriately right size the exposures within the total portfolio. Just given the overall significant growth of the total portfolio and the increased annual pacing targets for the private credit class, it's necessary to make larger commitments to managers. And so a lot of this activity is appropriately sizing those positions within the portfolio. And a part of the CIC discussion, the manager concentration was brought up. And so on a go-forward basis, we're going to include more additional information in this report that has manager allocations, so aggregate relation within the total portfolio on a go-forward basis. On page 53, a little bit more kind of on the cash flows of the total portfolio. Again, here highlighting how the program has changed. Here, we're showing the contribution and distribution activity of the program, and the green bars are distributions that have come out of the program from your managers. And just the significant activity in the third and fourth quarter, represents a transfer of assets and liquidation of assets. And while I mentioned, that's mostly the liquidating and legacy exposures, we do expect the green bars to be much more of a consistent basis. We won't see that variability going forward, but also want to note the increased contribution activity with almost 423 million contributed in the fourth quarter. as we're making larger commitments to more managers, we will consistently see increased commitment activity. So just really highlighting that this program will be in ramp up mode. That is that there'll be much more contribution activity going forward than the distribution activity as we are ramping towards that higher target allocation.
And just to put a finer point on it, that significant green bar that you see in Q3 of 2023, that's tied to the restructuring of the program out of hedge funds. So those were meaningful hedge fund redemptions, which tied to the overall restructuring of the program. So that's kind of a one-time event.
And there was a significant transfer of a public holding back to the public fixed income that contributed to that. So. And I will wrap up my comments on page 55, which highlights the Horizon IRRs for the 4 core sectors and the legacy liquidating. I just want to highlight that the 4 core sectors have really contributed to results across various time periods, but I really want to orient towards the latest 1-year period. Each of these strategies have generated strong double-digit returns. Again, the legacy and liquidating, which were a drag on performance. But this doesn't necessarily mean they were underperformers. They were, as Mary mentioned, they were hedge funds with higher kind of cost structures, but just, they had different roles and purposes within the portfolio. And as part of the restructuring, those will be liquidated and removed, but don't want to say they didn't perform the role that they were hired for. It's not the go forward strategy. But overall, the program continues to be diversified by manager, structure, and vintage year. It is underweight the long-term target of the asset class, but there has been significant commitment activity to the space, and there will continue to be to reach and maintain that target allocation in a disciplined manner. And with that, I will pause to see if there's any questions.
Thank you. Do we have any questions or comments from the council members? Okay.
And Madam Chair, Governor, council members, sincerely apologize about my lateness. Thank you, Mary, for being point on this. And just want to say that over the past couple of years, both the public and private allocation for debt market investments has undergone significant change, and we're pretty excited about the direction that things are going. So, thank you.
Thank you.
Thank you.
All right. We are now on that item 2E in the activity and performance report. That's the National Private Equity Fund Summary and PMR. And I see we've got our presenters coming, Chris Cassidy and Mercer. Welcome.
Morning.
Morning. Is it a good morning? Guys are very rote and trying to, mix it up just a little. They couldn't hang with Cassidy to get that.
So first on the National Private Equity Program, the portfolio is relatively stable, performing comparably to the index, or a little better. The portfolio is up 6.4% for the last year, and up 14.6% for the 3-year period. That compares to 5.5% for the Burgess Private Equity Index, and 10.6% for the 3-year period. Our portfolio has really kind of behaved pretty well over the last couple of years. It's the ratio of distributions to contributions has outperformed the index. So that ratio was 1 times. In other words, our managers sold enough assets to fund our contributions into the fund. The index was at 0.9. That's actually improved over the last year. There's been some stabilization in liquidity in the private equity market, and that's some combination of A-plus assets are still getting sold. There's a new asset class that wasn't as big a deal a long time ago, but that's Tom Lofton's asset class. The private credit asset class remains available to finance deals. And there's a third element called continuation funds, which are relatively new financial innovation, I think is the polite way to call it, that is allowing some liquidity for companies. Our portfolio is pretty mature. It is behaving, I think, a little better than normal, but we are seeing holding periods go up. And when you have a big change in the economic environment, and we had a big change in the last couple of years with increased interest rates and mortality and fun stuff in Europe, and so there were some things that occurred generally coming out of these periods, the holding periods go up 1 to 2 years on average across the asset class. Been most pronounced in the venture capital universe, where that part of the index, which is roughly a third of the Burgess index, continues to kind of dribble along and dribble down. It's had quite a drawdown of, depending on the fund, 40 to 50% drawdown. And that strategy, particularly on the software side, is looking for liquidity in the IPO market, which is not really open up yet. And then on the third side, as we begin to ramp this portfolio, our portfolio's NAV is $3.8 billion at the end of the quarter. With all the inflows the state's lucky to have, the portfolio is going to grow. And one of the investments we made last year is to begin the process of, as we get larger, begin to more intelligently put capital into this asset class and make sure we're paying reasonable fees. And one way you do that is through co-investment. So we did make our first co-investment through the Mercer SMA. These numbers start to get big over time as you increase that. We're not in this particular deal. We're paying a small management fee to Mercer, but we're not paying commitment fees. We're not paying carried interest. We're not paying the underlying manager of management fees. Savings really do begin to add up. As a reminder, we're going to use a combination of ways to do this. We're going to do, we did sign up the Mercer SMA last year. We set up a side-by-side co-investment vehicle with Bain Special Situations platform. Expect to see more of those side-by-side co-invest vehicles later in the year as a group. I'll pass on with Richard to walk through the report.
Thank you. I'm going to start on page 74 of the materials with the slide titled Performance Overview. We're covering the Q4 2023 performance today. We did have a gain in the quarter of 2.1%, which equates to approximately $80 million. That quarterly performance is similar to what we saw in Q1 and Q2 of the year, and in Q3 we saw a slight loss. And so the full year number is 6.4%, which, as Chris mentioned, compares favorably against the Burgess benchmark. And on a 3-year basis, it's 14.6%. Overall, the since inception portfolio return is at a 12.3%, which has generated an over $4 billion gain. We do break the portfolio down on this slide from 2011 and after vintage years, and then the 2009 and before, really representing when a new private equity strategy was implemented, so you can see what the impact was on that. And you can see that the 2011 and after portfolio has generated just under a 16% net IRR since inception and just under $3 billion of gain. From an activity front, we've completed 4 commitments so far in 2024 for $350 million, and we have 1 proposed new commitment today to present to you. On the next page, page 75, this slide has our typical summary of the numbers in the portfolio. You can see the net asset value there of $3.8 billion. It did increase by $80 million during the quarter, which is basically the gain that we saw because the contributions offset the distributions during that quarter. Year over year, you can see that from the table that the since inception return did go down because we didn't have double-digit returns on a 1-year basis. So the net IRR is down from a 12.5 to a 12.3%. The net multiple is basically the same at around a 1.6x. When you look at the strategies that have really done well are the buyout and growth strategies, which also have the largest allocation in the portfolio. Both strategies are at a 13.7% or greater net IRR. The next page, page 76, shows a graphic that details how the net asset value changed from quarter to quarter. You can see in the Q3 that slight loss that we had of $19.5 million. During the Q4, you can see the contributions and distributions were roughly equal, and then that gain of about $80 million there that led to the NAV increase. Through 2023, contributions did exceed distributions by $65 million, but we've continued to see healthy levels of distributions come into the portfolio, which is offsetting a lot of those capital calls from the newer commitments that we've been making. And so far in 2024 through mid-June, we're at a net contribution of $52 million. So we've continued to receive distributions in the portfolio that helps offset the capital calls. I'm going to skip ahead to page 78 to talk about some benchmarking really quick. This table shows the by vintage year look at the portfolio's performance against the Burgess private markets benchmark. We're targeting above median because we're building portfolios in each of those vintage years. And you can see in the 2011 and after, we're above median in every vintage year except 2013. And even in 2013, we're right at that cutoff of the median performance. And when you look at just absolute performance too, I mean, it's been pretty impressive across multiple vintage years. With the returns generating at 10.5% or greater in each of these more mature vintage years. Another benchmarking that we'll look at is on page 79. This is the public market equivalent, which basically calculates an IRR equivalent using public benchmarks. And you can see the MSCI ACWI, which is the more global benchmark, which is similar to the global approach that we have in the national program, that we're outperforming that by 5.4%. And then we also put in a couple of more U.S.-focused benchmarks that are more common, like the Russell 3000 and the Russell 2000, which is the smaller companies within the Russell 3000. You can see we're just barely above the Russell 3000, but that's been the benchmark really dominated by large cap tech that you've heard a lot about. And then, compared against the smaller company benchmark, we're outperforming there. We have some other slides about diversification in the portfolio, but I'll conclude there. I'm happy to answer any questions.
Thank you very much. Do we have any questions or comments from council members or staff? All right. Thank you very much.
Moving along to the New Mexico program, the portfolio from a performance perspective remains relatively concentrated in terms of the underlying companies in the portfolio, which is driving some volatility in performance in the near term. Did want to point out we've made a lot of commitments over the last year to try to really be impactful with the SIC's capital program. One of the things that's, in its early days, you make a commitment, it takes time for the capital to be drawn, it takes time for these groups to find investments, but we are seeing a little bit of increased competition in the ecosystem. Founders and entrepreneurs, and I'm hoping we start to develop more of them as we make early stage investments, but we're hearing anecdotally that some of the companies have competition for rounds, which is something we want to see. We want founders and entrepreneurs to have multiple shots on goal to be able to raise capital from who they would like to. I'll pass along to Richard.
Thanks. I'm going to start on page 93 in the materials, the slide titled Performance Overview. And it's been a challenging year for the New Mexico program. I mean, there's really two broad themes to highlight for you. The first is more macro, where venture capital has just had a challenging year overall. It's generated a loss in the broad benchmark. So venture capital has been challenging to generate performance over the last year. The second is, as you look at the breakdown of the different types of funds that we have, several of the older funds and the co-investment funds have had losses from valuation declines in their underlying portfolio companies, which has led to that one-year return of negative 20%. And that last year has impacted the since inception return, which is now a negative 1.1% as of year end. When you look at those longer term returns, there has been positive performance from the Recovery Fund, which is a more debt-oriented vehicle, and then the newer fund commitments as well. The newer fund commitments have generated a 9.3% net IRR or a $37 million gain, but the caveat is much of that value is unrealized and can be volatile in venture capital until it's actually realized. The reason why the fund investments are split between 2008 before and 2016 and after is there was a legislation change where there wasn't a requirement anymore to open an office in New Mexico, which broadened the funnel of managers that we could look at. And so it reflects that change there, and there was no fund investments made between 2008 and 2016. As Chris mentioned, we are making progress with diversifying the portfolio. When we started, 75% of the net asset value was with one manager at the end of 2018, and that's now down to 29%. And 3 companies accounted for about 76% of the value at the end of 2018, and that's now down to 32% for those 3 companies. So this should continue to be diversified as the new commitments are drawn, and we've already made progress this year on making several new commitments, and as they're drawn over time, that should further diversify the portfolio. real quick on page 94, you can see the net asset value here of $387.6 million. You can see here the year-over-year change as well for the since inception net IRR from the 0.7% to the negative 1.1% for the challenging year that we've had. In the quarter, the overall net asset value decreased by $15 million. And then you can also see the effect on the 10-year return in the graph below from 3% to a negative 1.2%. Page 95 shows the breakdown on the net asset value. The recovery fund had a small gain, while the co-investment funds had the larger loss of $27.7 million. The net asset value decrease was really driven by that loss, but it was also offset by some of the contributions that were coming into the fund, which you can see on this chart. Regarding cash flows, we are at a net contribution position of about $50 million through 2023. And then, for 2024, we're at about a net contribution of $33.4 million. So we are getting much more contributions than distributions in the portfolio, but that's also reflective of the broader weakness in venture capital that the industry is seeing right now. I'm going to skip ahead to to page 97, where we talk about the economic impact, because the returns are one aspect, but then also the economic impact is the other. We have 119 New Mexico-based companies that have received investments in the program, with 2 companies receiving investment over the last 12 months. This is as of Q4 as well. We actually have some new companies that have been invested in 2024 that you'll see in future performance reports. 46% of those companies are still active in the portfolio. The total invested by the SIC in these companies is $385.8 million. So that's your portion of these funds that have gone into these New Mexico companies. And then when you look at the broader fund, because in many of these vehicles there are multiple investors, those funds have invested $525.8 million in New Mexico-based companies. And the amount invested over the last year is $10 million. The next page has more economic data about jobs and job growth. You can see that from a job growth perspective, they're basically the same quarter over quarter, with about 4,909 jobs across all the companies. As I've mentioned in past reports, a lot of the job growth that we saw in the next line has been from the recovery fund, as a lot of those companies started hiring again post-COVID. And the job growth really tracks what were the jobs as of the initial investment that the SIC made to Q4 2023. So tracking how much they grew jobs over time. And then you can see the annualized New Mexico payrolls of just over $200 million, and expenditure on New Mexico goods of $228 million, and that's basically not much change quarter over quarter as well. I'll conclude my remarks there. Happy to answer any questions.
I'm going to step out for 1 minute. I'll be right back, and Secretary Fox is in charge.
Thank you, Richard. Are there any questions or comments from council members? Violence is rubbing off on you. If there aren't, well, thank you very much for that presentation, and we'll move on to item 2G, Q4 2023 real estate EMR. I assume this is an update. Again, Mercer and Keith.
Hold on a second. Real return.
My apologies. I should have.
We're anxious.
Townsend, not Mercer.
No, that's okay. Real return is Mercer. We're going to do that first, I think, and then I'll pick up with the real estate.
Okay. Thank you.
So, I guess we'll start out with the real assets. The presentation begins on page 113. Amy Ridge is going to join us remotely today to do the presentation. She's traveling for an important family event. Has been kind enough to make time for us this morning, so thank you, Amy, for that. Also want to thank Amy and the Mercer team for a speedy and thorough transition of the real asset reporting following the shift in responsibility between consultants. The format for this presentation is still a work in process, and we expect that will evolve over time with the structure study in particular. One of the key enhancements envisioned has as we go forward is a bit more granular reporting with respect to the infrastructure sleeve in the portfolio. We anticipate that will be broken up into communications, energy, social, transport, and logistics, and utility subsectors. With that, I think I'll stop and hand off to Amy.
Great, thank you, and good morning to everyone. Our report actually starts on page 116 in your materials, the slide titled Performance Overview. So we are covering the Q4 2023 performance for the Real Assets program. Overall, there was a quarterly gain in the portfolio of 1.8%, which equates to about $61 million. This gain was driven by the Real Assets portfolio. You see here is up 2.3% in the quarter, partially offset by a small loss in the financial assets and MLP holding. A quick reminder, in the real assets bucket, it includes all of your investments within energy, infrastructure, agriculture, and timber. And then in the financial assets and MLP bucket, you have your 1 MLP investment and 5 debt-related real assets funds, which was mentioned previously in the private debt presentation. Those will actually be moving starting next quarter into that portfolio. So overall, positive performance across each of the time horizons, and a since inception return of 6.3% as of December 31st, 2023, total gain of $1.2 billion. On the next slide, we're summarizing the numbers in the portfolio. I'm just going to highlight a few here. Your year-over-year increase in both net IRR and net multiple. Your net IRR increased 6% to 6.3, and net multiple from 1.24 to 1.27. And then looking at strategies, the largest investments by both number of investments and committed capital is in your infrastructure and energy buckets. These are also your highest IRR generators. However, energy has been less of a focus in recent years, which is reflected when you look at the NAV. There's a significantly larger NAV in infrastructure compared to energy. On the next page, page 118, this graphic shows the changes in net asset value over the last 2 quarters. So the net asset value increased by $91.7 million during the quarter. This was driven by 2 things. So your contributions exceeded distributions, and you had your net gain of $61 million. Also, 41 funds reported a gain versus 20 who reported a loss in the quarter. On the next page, we show the top cash flow activity and the top gains and losses by fund. So overall, you see on the left-hand side, contributions outpaced distributions in the quarter. And on the right-hand side, you see there were more gains than losses. And also an important metric, you had 5 funds produce gains over $5 million within each of those funds, which is a strong metric to see within the portfolio. The next slide is the public market equivalent, or the PME calculation over the last 10 years. We do this by calculating an IRR using the cash flows from the portfolio against an inflation measurement plus the 300 basis point premium. And you see the real assets portfolio is about even on a PME basis as of December 31st, 2023. And the last 2 pages I will cover today, they're really showing you the underlying diversification of the portfolio, which is something Keith and myself spent a lot of time thinking through. On page 121, you see the strategy breakout. So you will see, obviously, infrastructure is the largest allocation, followed by natural resources. Infrastructure looks really large, but I just want to remind everyone within infrastructure, there is a lot of underlying strategies. You have things like transportation, social, data centers, renewables, things like that. And so as Keith mentioned, we're working on breaking this infrastructure bucket down so you could really understand those underlying diversifiers. So more to come as we work through that. And the last page I will review is page 122. Again, diversification by geography and sector. Most of the portfolio is in North America, followed by Europe and emerging markets. And from a sector perspective, the largest 2 weightings, again, are energy and infrastructure. So with that, Keith and I are happy to take any questions on the performance report.
Thank you, Amy. Appreciate that. Are there any questions or comments from council members? Anything from staff? All right, thank you both very much.
Thank you.
And we'll move on to item 2H, Q4 2023 real estate EMR.
Great, Mr. Chair. Rob Coaches is joining me from Townsend for this morning. Quick summary on real estate. The presentation begins at 1:33. The real estate portfolio over the course of the trailing 12 months declined approximately 10% at best of the Odyssey's net benchmark for the year by about 2.5 percentage points, and we remain ahead of the benchmark for all longer multi-year measurement horizons. The higher for longer rate scenario is still being baked into valuations. That's a negative for current marks and also for short-run performance, as the higher rates will cause valuations to decline somewhat. We expect that will be partially offset by strong fundamentals and NOI growth. The net of those two factors over the immediate term will likely be modest negative returns over the short run. That does create a measure of good news, and that is that the valuation pressures do create opportunities for capital deployment. We certainly have ample capital to deploy, particularly value add and opportunistic. So that all, for additional details.
Okay, thanks, Keith. Yes, as Keith said, our materials start on page 130. We have an extra heavy set of real estate pages in your book this month because we're doing year-end 2023, and at the year-end we do some summaries of each one of your investment positions. So we have about 200 pages of materials. I'm only going to cover 6 today, so bear with me. The real estate allocation is 12% of your total investment portfolio, and that's about just over $5.2 billion. Your current market value as of year-end 2023 was $3.6 billion, about 8.3% of your total investment portfolio. Real estate's playing a little bit of a catch-up. We were a little bit behind last year when you increased the allocation further, and your plan is growing rapidly, as you know. So it takes time for managers to invest the money that you've committed. You've committed over the last year, or at least committed and or approved, subject to legal, almost $2 billion of new commitments. So there's enough in the works to get you to your allocation target. But the market is very slow right now. As we look back over the last 2 years since the Federal Reserve started raising interest rates, the real estate markets more or less froze up, and in the U.S. alone, transaction volume is down over 50%. So if you look at the volume of real estate trade, commercial real estate trades in the U.S., down over 50%. So it's taking longer for the managers to put money to work in this market environment, and they don't want to put a lot of money to work when the valuations are declining. So I'm going to start on page 133 in the materials. And as Keith said, your real estate performance is good on a relative basis. It's not a happy thing to report that you're beating your benchmark when you were down 10% last year overall. But on a relative basis, things look good. And overall, we feel pretty confident about the real estate markets right now because as we look at fundamentals, that's supply, demand, rents, occupancy or vacancy, almost all real estate sectors are performing very well. You'll see some headlines about the office sector, which is becoming a smaller part of every institutional portfolio. But overall, outside of that sector, real estate is performing very well at the property level. But the problem is the market had to correct to this, record increase in interest rates from record low rates to basically doubling in a very short period of time. And so this is what, we kind of look at this as a classic capital markets correction in values. And as we look at where we are in the process, we know that the first quarter numbers are coming in negative again, down another 2% or so, and probably the June 30 numbers will be flat to slightly negative again. But we feel pretty good about where we are in that cycle of correction. And as we look at our forward-looking information from your managers on real estate valuations as of June 30, what we see is a couple of things, a critical reversal. So if we look at the real estate yield versus the risk-free rate, which we use the 10-year Treasury yield, for the first time in a couple of years now, that spread has turned positive. So you're getting a higher yield out of real estate than the risk-free rate at the 10-year Treasury. And same thing when you look at overall real estate borrowing rates versus projected total return. Again, that spread has turned positive. And the last proxy we look at are the public markets, and the public markets have bounced back over the last year, up about 7%, but up 21% since very much the trough of the correction in the public markets since the Fed started correcting, or rather raising interest rates. So overall, all of those things tell us that we're reaching an equilibrium point in valuations relative to interest rates. And we're coming out of this with strong fundamentals in almost all sectors in real estate. So as an advisor to a lot of institutional investors, we just tell our clients at this point, just remain patient. It's hard when the markets are down, but remain patient because we think things could be turning around here at the end of this year or early next year. I'm going to skip to page 135. We do track, this is your non-core portfolio. A couple of comments here, and it's, again, good positive performance out of this part of your portfolio as we look back at your more or less vintage year rankings of non-core investments in your portfolio. Going back to 2011, 7 out of 9 periods, you're above median performance in your collection of investments in each vintage year. The 2 that are below median, you're still at a positive number. One is just south of 10%. And the consistency year by year over these vintage years is pretty attractive in terms of, in most cases, solid double-digit returns out of the non-core portfolio. This is where, frankly, we expect a lot of activity going forward as you grow your program and as we look at your, liquidity requirements and the need to kind of shift to more of a growth-oriented portfolio versus a portfolio that's looking for income. We're going to be doing a lot more activity in the non-core sector, and frankly, we haven't made any core investments in a couple of years in your portfolio, and probably won't until sometime next year. Might look at some changes there. I want to skip ahead to page 139 in the materials. I hope I have your page numbers correctly. And we also do a public market equivalent analysis for real estate, and the real simple comment here is it looks very good. If we look at your private market real estate relative to a public market equivalent, again, it's the same analysis that Mercer just talked about. You take your cash flows and apply them to the public market performance. You're getting a good solid 300 basis points illiquidity premium. So you're getting compensated for being in private markets. That's the message of this slide relative to public market performance. And this analysis goes back really since 2004, so that's over a long period of time. Skipping ahead to page 146, and we track diversification in your portfolio in a lot of ways. I'm going to talk today about property type diversification, geography within the U.S., and then your global exposures. And a couple of quick comments. First, the program is very well diversified across all these metrics. In particular, the industrial exposure that you see, which is the most significant overweight on a property type basis, has really boosted your performance. And if you look through some of the materials in our book here, you'll see a lot of references to really strong returns out of that sector. And that was a dedicated initiative to kind of get more exposure to a sector that we saw had a lot of legs because of things like the advancement of e-commerce and a lot more warehousing activity versus sticks and bricks traditional retail centers in real estate. On a geographic perspective, again, you're very well diversified across the United States. Probably a little underweight, not a little bit, you are definitely underweight to the Pacific Coast markets and to the Northeast. Again, that was a deliberate underweight in your program as we focused on population migration from north to south and a lot of investment in the southern part of the country. And again, we expect to address that going forward. I think it's time to start looking back at the Northeast and the Pacific markets going forward as we come out of this market correction. So expect some discussion about that in the future and maybe some specific investment initiatives to kind of rebuild those weightings in your portfolio. And on a global perspective, your program is 83% U.S. You do have a good, significant exposure to overseas markets. Most of that is, the heaviest is in Europe. Your overseas exposure, by and large, is to developed markets. You do have a little bit of emerging market exposure, but not that much, and basically the managers that are investing overseas are focused on good, stable, developed markets. One comment about property type diversification, and maybe turn to the next page. The benchmark that you use, which is published by NACRE, is undergoing a transformation in terms of how these different sectors, these different property types are defined, what fits into what category, and then there's an expansion of the NACRE definitions focused on a lot of specialized property types. And you've seen this in some of the more recent investment proposals that we brought to you. We've been focused on a lot of niche sectors with very specialized managers, and that is a little bit of the wave of the future. So historically, 95 to even 98% of institutional investors like you, I should say 95 to 98% of their investments were focused on 4 primary property types: office, retail, industrial, and apartment or multifamily. And what's happening is institutional investors are exploring a lot of other subsectors or other non-traditional sectors, and there's a lot more activity in those sectors. And so NACRE, your benchmark, is accommodating that, expanding the definitions of what's permissible to go into your benchmark, essentially. And so you'll see a lot of specialized property types on this page, on page 147, I believe, is in your materials. Everything from data centers to parking lots to life science and medical office, student housing, manufactured housing, single-family rental. A lot of activity in these niche sectors, and even some of the definitions have changed. So instead of apartment and multifamily, going forward, it's going to be residential, and that residential component will be a lot of other not traditional apartment buildings, but other types of housing. On the apartment sector, one issue to note that's getting into the headlines today is there's a developing controversy related to how apartment managers are setting their rents across the country. And we've seen a couple of lawsuits filed. We've seen the Department of Justice is looking into this issue, and it seems to be a growing trend. So you might see some headlines on what they call dynamic pricing models. And a lot of the managers and property managers in the apartment sector use various apps and algorithms, if you will, to help them gather very detailed local market information, and then employ that when they reset rents for vacancy in their units. And several plaintiffs' lawyers and now the DOJ is looking at whether or not those algorithms amount to price fixing and under antitrust laws. And so that's a developing issue. We know at least 30 groups, including some of your managers in your portfolio, that have been wrapped up in some of these private lawsuits and have received subpoenas for information from the Department of Justice. So keep an eye on that. That's a developing trend. It's interesting that the apartment sector is using this dynamic pricing model, but it's very similar to models that are used in the airline industry, in the hotel industry. So it's possible that kind of argument against that type of algorithm might expand into other sectors as well. But in any event, just a headline risk, if you will, to keep your eye on. And we'll be watching that as we look at boosting some of your residential exposure going forward. The last page, the next page that I'm going to talk about today is we always follow your strategic guidelines with respect to real estate, and the simple takeaway from page 148 in your materials is that your program is completely in compliance with your guidelines, and the primary issue for you is just boosting your exposure given your growing plan and your growing allocation to real estate. And so we'll be focused a lot on some intensive investment activity over the next few years. And with that, I'll stop there and open it up to any questions.
Thank you, Rob. Appreciate that. Any questions from council members? Comments? Thank you.
Okay, good.
That wraps up items under 2 on today's agenda, so we'll move on to 3 investment matters, portfolio recommendations, and informational items. We have 3 action items today, but we'll start off with a report from
Thank you, Mr. Chair. We had a good meeting of the investment committee last week. We had a quorum, and we did recommend the two investment matters for council approval unanimously. We did not have a chance to review the asset allocation item that's on the agenda because those materials weren't ready yet, which is, understandable just given the pace of business, and appreciate all the staff's hard work. But yeah, we're reviewing that at the same time as the council. So that's my report for today.
Thank you. Appreciate that, Chairman Bingaman. We'll move on to item B, action item, asset allocation, tobacco settlement permanent fund, capital development and reserve fund, and workforce development and apprenticeship trust fund. Thank you, Mr. Chair. I'll start out, and then we're going to bring Matthias in here in a minute. But we've got three funds to review today. One for a review of its current asset allocation, that's the tobacco fund, and then two new allocations for the capital development and the workforce development fund. So let's start on page 243, if you would. You're familiar with this matrix. We put since the number of funds have grown, we sort of put them on a risk scale here in terms of the relative riskiness of the investment risk of their asset allocation. Starting with the tobacco fund here, there was two changes to that fund in this last legislature. One, legislature removed the reserve status of this fund. That is a signal to us that we can take a little bit more investment risk, try to get a little higher rate of return since it's not in the reserve anymore. Second, the future inflows into this fund are expected to rise from 50% today to 100% inflows going forward. So both of those things very positive. We're taking a little more investment risk with this fund. I think it belongs in that same category as the early childhood fund, the opioid settlement, and the higher education trust fund. So just a little bit more risk into this portfolio. A little bit more publicly traded equity moving from 20% to 40%, and so forth in some of the other classes. We'll pick up a little bit in return. Matthias will go into this in a little more detail. Our expected return anyway, on a arithmetic basis. But we think we can take a little more investment risk here, do a little bit better in returns for the state with this. And Matthias will be up in just a minute here with some details around the actual allocation. Let's flip to 249. And this is the capital development reserve fund. Based on the distribution here and the fact that this fund can be used, can't have outflows of the fund in addition to its distribution rate, we think this fund needs a little bit more of a liquidity profile. Still have some equity in there, about 30% on publicly traded, and another 5 or so, 5% on private equity. Still a pretty good return profile, 6.7% on arithmetic, and 6.2 on compound. But just because of the liquidity needs of this fund, we think it probably deserves the spot, the enhanced liquidity spot on our risk spectrum. And Matthias will be back with some details around it. And then finally, let's go to 255, at least for now. This is the workforce development and apprenticeship fund. This one's a little bit different. This one was allocated $30 million, and with a fixed distribution of $5 million in the first 2 years of the fund's life, and then $3 million a year thereafter until the fund is exhausted. It's approximately 8 or a little bit more than 8 years worth of distribution for this fund before it's exhausted. So this fund doesn't really lend itself very well to a fixed asset allocation. Much more of it lends itself much more to a strategy as opposed to a fixed allocation. And actually, even though this fund's $30 million, we've probably spent more time on it than some of the others, just because of that fact. And we don't often get to do something custom like this, so it was enjoyable. We had two of our external fixed income managers consult on what we might do for strategy for this fund. Of course, internal discussions among our strategy group and with our fixed income team, and of course with RBK on strategy. I'll leave that there for now and have Matthias go back on tobacco and capital development, and I'd like to come back and kind of walk through that strategy. That's what we'll be asking for approval of.
Yeah. Great, thank you. If I can turn you back to page 242, and as we've done as these new funds have come online, we really look at the legislation, the guidance that was put forward in terms of what the investment objectives, what the restrictions, constraints are, and try to find the best fit across the current categories that is highlighted on that matrix on the next page, 243. So that's our baseline, and most of the time, especially as those categories have expanded, we find pretty good comparables or fits, but other times a new category has to be created. Mint mentioned some of the key factors that are driving the overall asset allocation recommendation. As you can see here on page 242 in aggregate, when you look at it all, the early childhood is a good fit for the aggregate objectives of the back settlement fund with the reserve status removed. It will earn enough on an expected return basis to provide for the 4.7 distribution net of inflation. We think that's helpful. And in fact, the change from the existing allocation to the new allocation, you can see that both numerically on page 245 and then graphically on page 246, moves you up and to the right on the efficient frontier, but then also importantly, has a slight benefit in terms of additional liquidity. So overall, we think that you have some incremental gains with not really any trade-offs. So we think that's a good place to be. Again, tobacco originally was more conservative given the reserve status that had. What you'll see there is a recommendation to adopt early childhood policy target asset allocation for the tobacco settlement trust fund going forward. Pause here for any questions before we look at the capital development fund.
Any questions?
Okay. Take you to page 248, and this is a larger fund than the workforce development fund with $500 million expected anytime now, end of the month, maybe early July. And while there aren't any explicit investment objectives, we do have some understanding in terms of what the return expectations are based on distribution rate. You can see that is a 5% of a trailing period, initially 1, and then that moves up to 3 calendar years. But importantly, these funds are subject to appropriation, which of course emphasizes liquidity, being able to actually have those money available. So trying to find an asset allocation that strikes a good balance between earning investment return and growth, but also emphasizing the liquidity within that. And so that was a little bit of a challenge, but I think collectively we struck a good balance. You can see that on 249. We plotted this in between the moderate growth, which is where ECE and some of these other funds have been in yellow, and the TSR, which is quite conservative. So with this new category, orange, titled Enhanced Liquidity, it really does exactly that. It's a bespoke allocation, trying to maximize returns without sacrificing liquidity. So of course, that leans into the public market some, but then also tries to take advantage of higher incremental returns that you'll find in private market. You can see here an expected arithmetic return of 6.7 within the purple highlighting there. That compares to ECE on the left side, so modestly more aggressive of 7.5, and then TSR on the more conservative side of 5.4. So somewhere in the middle of those two, and that was the objective that we set out for. On a max drawdown worst case scenario, we're looking more in the mid-teens rather than in the low 20s compared to some of these more growth graphically on page 252, that might be easiest in terms of where things are slotting, and again, providing EC and TSR as guideposts. And you can see the capital development fund in blue, lying close to the efficient frontier and between those two funds. Again, when you look at it holistically, I think this is a pretty strong allocation for balancing those objectives of high distribution, but also high degree of liquidity as an appropriation.
Thank you, Matthias. Any questions on the capital development reserve fund asset allocation recommendation? Let's go back to you on.
Thanks, Mr. Chair. Let's shoot back to page 255. I mentioned at the top that this portfolio doesn't really lend itself to a static allocation like you just saw for those other two. $30 million was appropriated, and they'll receive a distribution of $5 million this year, $5 million next year, and then $3 million per year in years after that until the fund's exhausted. That's just slightly over 8 years worth of distributions, assuming no return on the fund. So, first reflex when you get a fund like that is to be very, very conservative with it, cash and short duration investments, so that you don't wind up with a drawdown, particularly toward the end, that stops the distribution if they were otherwise expecting. So a low rate of return on investments like that probably put them into 9 years worth of distribution. But we worked with a couple of our external fixed income managers, with our internal fixed income team, our strategy group, and RBK to try to figure out a way that we might get them another year or two, even 3 distributions because of investment return without putting near-term distributions at risk, and trying to get them at least that 8 or 9 years worth of distributions. And I think we've come up with a plan. So page 255 shows it in graphic form. So you see the $30 million distribution or $30 million contribution to the left-hand side. We break that into 3 tiers. Tier 1 is the distribution for the next 12 months. So that would be the initial $5 million distribution. Would sit in our cash pool. Right now, it's not bad. Given over 5% yield on our cash now. That won't be the case, in the future, sure, but at least for now, it's not a bad place for it. Tier 2 is the next year's distribution. So that would be, right now, it would be another $5 million. We could take a little bit of credit risk with in the short duration portfolio. So no real interest rate risk, all short duration instruments. But just a little bit of credit risk and start earning some return on that money. And then tier 3, we propose a mix of 50% of our credit plus pool and 50% of our private market fixed income pool. That's a big jump in returns from the previous two options. If you look at page 255, this shows the pool as it draws down over time and the distribution or how the money would be invested. So the real power of this structure is the orange section there, which is our higher returning assets. So we're putting most of the money up front in higher returning assets and expecting that money to compound as much as it can as we slowly have to decline it over the next several years. So instead of 8 or 9 years worth of distributions under the normal expectations of returns from those asset classes, we think we can give them another couple years of distributions, just a low returning portfolio, without much risk at all of them not being that easy. So we think the structure works. It would mean change in the actual asset allocation each year as we made a distribution. It had to refill those 2 buckets. And you can see how it would decline. But what we propose is that strategy rather than a fix. In terms of the actual allocations.
And Madam Governor and council members, I really want to commend Vince and the entire team for the time they spent on this. Although we recognize this is a very small dollar amount compared to our total assets, it's very important for the purposes of workforce development. Vince and I also had the opportunity to meet with Secretary Nair to present this strategy to her, and she really liked the idea of taking on very modest risk while being able to get an additional, hopefully 2 or even 3 years of life out of the program. So she very much supports this.
We also told them that we hope they get an additional distribution and it's going to become more permanent. We'll work on that. Okay, I'll get us through this item before turning it back over to the governor. Are there any questions, comments on either of the 3 items under 3B? Governor, I haven't succeeded in getting us to have any more fun than you did. So sorry about that.
I gave you plenty of time.
With Caroline Merkel.
Yeah, fair enough. All right, so we are on item 3B, and we are ready for the vote, I take it?
We are.
All right.
Mr. Bingaman, are you going to do the motion on this?
Sure, Mr. Chair, I'll go ahead and do that. It looks like staff is recommending we do 3 separate motions, one for each fund. Okay. Based on the recommendation of General Consultant RVK and SIC staff, I move the State Investment Council authorize the asset allocation plan for the Tobacco Settlement Permanent Fund as memorialized and discussed by the council at today's meeting.
Second.
All right. All those in favor say aye. Aye.
Aye.
Any? All right. Hearing none, that motion, that vote carries.
Okay, moving on to the Capital Development Reserve Fund. Based on the recommendation of General Consultant RVK and SIC staff, I move that the State Investment Council authorize the asset allocation plan for the Capital Development and Reserve Fund as memorialized and discussed by the council at today's meeting.
We have a second. Thank you very much. Any discussion? Questions? Hearing none. All those in favor say aye.
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 Any opposed?
Aye.
There's a delay. I go too fast. All right. Hearing none, that motion and vote carries.
Based on the recommendations of General Consultant RVK and SIC staff, I move that the State Investment Council authorize the asset allocation plan for the Workforce Development and Apprenticeship Trust Fund as memorialized and discussed by the council at today's meeting.
Second.
We have a second? Second. We have a second. Any questions or concerns, statements? Hearing none. Call the question. All those in favor say aye.
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 Any opposed? Hearing none, that carries. So we have 3 affirmations for asset allocation: Tobacco Settlement Permanent Fund, the Capital Development and Reserve Fund, and the Workforce Development and Apprenticeship Trust Fund. Thank you. We are now on item 3C, which is private equity, and we're going to hear from Cassidy and Richard again. And this will also be an action item with the vote.
So, we're bringing one investment this month. This is a biotech venture capital firm called Fraser Life Sciences. They have a couple different funds. One is an early stage venture capital fund focused on the company creation Series A stage that also selectively invests in public structured transactions, which Richard and Dr. Jamie Brush will talk about. And this fund we're bringing this month is a public fund which invests in both structured transactions and public equities as well as late-stage crossover rounds in private companies. To give you some overall context for all this, healthcare is roughly 17% of the venture capital index. This will probably be our last manager addition on the venture capital side in biotech. We've built what we think is a really great portfolio, kind of our dream list of managers that we've been pursuing for a while. And we're quite diversified across stages from company creation all the way to structured transactions on the public side.
Fraser Life Sciences is a strong manager in the life sciences.
Hold on, guys. What page are you on?
268. Is it 268 or 286?
286.
286.
Your memo is on two.
Yeah. My memo, and it depends on which one.
So Fraser Life Science, I mean, this is a strong manager in the life science space. They focus on biotechnology and therapeutics. They have been on our forward calendar for a while, as we wanted to put this manager into the portfolio and working to build a relationship with them. While this strategy does focus on public equities, there's a lot of private equity aspects to this strategy, and it was done in venture fund previously by them. Of note, they when they do identify a company, they try to find the best way to get into that company, not just necessarily buying stock in the public market. They also utilize themes, target specific companies that they want to own. And then there's a value add component to the strategy as well, where they're able to provide that technical expertise to companies to help them improve and increase value that way. Their platform, they have more than 30 years of experience within the healthcare investing. They're led by 4 partners with 2 managing partners that oversee both strategies. The team members, what's really interesting about Fraser Life Sciences, the team members have more than just the investment experience. A lot of them will have medical experience or consulting experience that really complements their investing experience and adds to the overall strategy. In addition to the investment team as well, they have 6 industry experts that they utilize in an entrepreneurs in residence program and 7 venture partners. You can see in our report that returns for the fund has been strong over the last 3 years, which beating both the venture capital benchmark and public indices that focus on biotech. From the terms perspective, they are similar to what we see for other venture capital funds. There is an overage fund here as well that has a very favorable fee structure, which, when you combine the 2 commitments, it makes it an attractive investment from a terms perspective. We're recommending a $50 million commitment to the Fraser Life Sciences Public Funded Overage Fund. So I'll turn it over. Thank you. That's a good summary. My name is Jamie Brush. I'm the general partner at Fraser in a position. I trained in internal medicine at Harvard and then was with the Boston Consulting Group for a number of years before joining Fraser in 2016. I'll give you just a brief overview of Fraser as a firm and then talk a little bit about the strategy that the public fund employs. Fraser is a dedicated healthcare investor. We've been around since 1991. The fund was originally founded in Seattle with a core thesis of being a specialist healthcare private equity investor. At that time, the fund invested in 2 core strategies out of a single private equity fund vehicle. There was a healthcare services business and a venture biotech business, both investing out of a single fund. Each of those strategies has its own set of GPs and its own allocation within a single commingled fund. And over the course of 7 vintages, performed very strongly. To the point in 2016 where the fund made a decision along with our LPs to split into 2 separate funds. Growth Buyout Fund, still based in Seattle, and the Life Sciences Fund that invests in early-stage biotech companies based in Palo Alto, California. I'm one of the GPs on the Life Sciences team in Palo Alto. So starting in 2016, with the first dedicated Life Sciences Fund, we were investing in early-stage private biotech companies. But within those venture funds, we had something that we call a public sleeve. And biotech's a bit of a unique sector in that the due diligence that's required to be successful investing in early-stage biotech is really focused on science, clinical medicine, clinical trial design, and the statistics around clinical trial designs. And that core set of competencies can be applied to both private companies, but also to public biotech companies that are at a similar stage of development. So those public sleeves in the venture funds are really focused on generating high IRRs and mitigating the J curve early in those VC funds. And that's exactly what we did over the first 3 vintage dedicated life sciences funds. We performed very strongly to the point where we, again, together with our LPs, elected to raise a dedicated public vehicle to further scale that approach of really applying venture capital to public markets. And so in 2021, together with my business partner, Albert Cha, and the 2 other managing partners of the fund, we launched the Fraser Life Sciences Public Fund, which is a long-only investment vehicle that runs in 3-year cycles designed to invest in small-cap public biotech companies. And it's really, as I said, a venture capital approach to public equity, where we are negotiating bespoke transactions with these companies and financing them through value-creating catalysts. Those could be things like clinical trial outcomes or regulatory designations like FDA approval to get a drug ultimately on the market. We work with these companies. We help them think through clinical trial design, statistics, the indications they should bring these medicines forward in. And so it's very much, as I said, applied to public markets. The fund runs in 3-year cycles. We launched the fund in mid-2021, so we're coming up on the 3-year anniversary. At that point, the fund is now reopening for new capital. We expect a one-and-done close on July 1st, at which point we will begin drawing down capital again for this second 3-year investment cycle. The fund is a hybrid private equity, public equity structure that we call Capital Quarterly. And when we exit the position, we distribute the profits back to our LPs and recycle the principal. And so the fund size stays the same during any given 3-year period, and it has a DPI component to it the way you would see with a private equity fund. So I think if you were to ask me what makes Fraser different, I think it's the integration of the private and the public funds. Our private team and our public team all sit in the same office. We're all RIA, so we're all under the same regulatory umbrella, and that enables us to share information and be very collaborative. And so, for example, by the time a company goes public in our sector, our private fund will have often seen them multiple times over a multi-year period. That just gives us an advantage in understanding what these companies do and their prospects as public companies. And so that's a little bit of kind of the secret sauce that we bring to public market biotech investing. So with that, I'm happy to answer any questions. So thanks for your attention and consideration.
Thank you for your presentation. Do we have any questions or comments from the council members? All right. Hearing and seeing none, vote. I think we're ready to call for a vote on whether or not we make the investment. And I'm assuming, is it still Member Bingaman?
Yeah, Madam Chair, I'll be happy to make the motion.
Thank you for doing that.
Based on the recommendations of the Council Investment Committee, private equity consultant Mercer, SIC staff, and general fiduciary oversight from RVK, I move that the State Investment Council approve a commitment of up to $50 million to Fraser Life Sciences Public Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
We have a second? Second. We have a second. Any questions, comments, concerns? Hearing none, let's call for a vote on the question. All those in favor say aye.
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 Hearing no opposition, the authorization for that investment is approved. Thank you for your presentation. We are now on item 3D, and it is an action item on private debt. And you see that we've got Dr. Nikita coming up once again to walk us through this proposal.
All right, well, we're playing cheers here. Thank you, Madam Chair, Governor, council members. Staff, in consultation with Nikita, is recommending a commitment of up to $200 million to the AB Carval Asset-Based Fund. With me on this presentation is Mary Bates down at the end there from Nikita, Aaron Montano, Managing Director with Alliance Bernstein, New Mexican native, a lot of family here, seems to find a lot of reasons to need to visit here personally. We also have Matt Hansen, Managing Director with Carval, and then finally we have Ms. Jody Gunderson. She is a Managing Principal, and she's a member of the Investment Committee at AB Carval, and really I would call Ms. Gunderson the keystone behind the strategy, the execution, and the oversight of the team. I'm going to speak very briefly to portfolio fit, and in order not to overlap with as little as possible with Ms. Bates, we'll turn it over to Nikita afterwards, and then finally we'll end up with a presentation from the carve-out team. So just to start with, frankly, from day one that I joined New Mexico, I've been a big proponent of asset-based finance strategies. They provide a more direct path to the underlying assets. The underlying loans tend to have shorter lives, so there's a lot of chance for reinvestment. There tends to be great diversity in the underlying pools as well. From a portfolio standpoint, asset-based finance loans are diversifying to much of our corporate loan strategy, and then specifically, carve-out will help the portfolio diversify geographically well. And then when we, going back to the private debt structure study goals in terms of income recycling, material portion of this strategy's returns will be generated by income as opposed to price return. There is opportunity for recycling in this structure as well. And then finally, with regard to carve-out itself, asset-based finance takes a lot of experience in its structure. We've looked at a lot of managers over time. I think my first visit was a year ago, maybe to Minneapolis to speak with carve-out. So we've seen a lot of managers. Frankly, carve-out with its infrastructure experience, and honestly, with Ms. Gunderson at the helm, they check the boxes. So with that, I'll turn it over to you.
Thank you, Tom, and thank you to the trustees. So AB Carvel Asset-Based Fund is a global income-focused asset-based specialty finance fund. It's targeting a net IRR of 10 to 13%. The strategy focuses across three primary segments of the specialty finance segment: the consumer, residential-related assets, and commercial-related assets. The GP has the flexibility to express relative value across that broad range of asset types that include but are not limited to credit card receivables, automobile loans, home improvement loans, residential solar leases, and equipment leases. I'm sure that the manager will go into greater detail on that point. As Tom has already alluded to, the underlying loans are very diversified at the loan level basis and have a weighted average life of approximately 2.5 years, so fairly short dated. These are all expected to be performing loans as opposed to non-performing loans. That's to say that there isn't expected to be much upside potential associated with these assets, but they're expected to be very consistent and have a strong yield or current income component. As Tom has alluded to and has referenced, one of the things that we like about this strategy is that 50% are expected to be European deals, with an emphasis predominantly on the UK and on Northern Europe. As I typically do when I present these strategies, I'll quickly walk through the strengths as we identify them, as well as some of the concerns and weaknesses, as well as the associated mitigants, and then turn it over to the GP. So the strengths, I've already alluded to this: flexibility. As we articulate it in concert with Director Lofton in terms of helping to construct this portfolio, we have a preference to give the GP, the manager, discretion within their vertical to express relative value than taking a siloed approach. And so that's consistent with this manager's strategy. They have a broad range of underlying asset types as well as asset structures that they pursue. We also very much like the fact that this will have a strong non-U.S. presence. Given the other managers that you already have in your program, that's something that we were looking to further diversify. We also like the structure of the vehicle, and I'm sure the GP will go into greater depth around that. But one of the key things that we like about this is, given your positive cash flow profile, we are focusing on strategies where there's the option to reinvest. So the strategy at the highest level is compounding interest, and that's what the strategy does. The other key benefit that we see of Carvel as it relates to this strategy, we do think the GP entity has a strong sourcing advantage, which ties to their strong experience and presence in this space. It takes a long time to build relationships and build platforms in these highly niche, highly specialized segments of the market, and this general partner has strong relationships in place, including some ownership of platforms as well. Some weaknesses or concerns that we would identify with this offering, we would highlight this is a first-time fund for the general partner. Always associated with first-time funds, there's some we always assume a level of haircut associated with the performance that's presented, because it's not necessarily one-for-one in terms of the strategy. We do think there's a strong mitigating factor associated with that in terms of its breadth. They've presented over close to $11 billion of equity, over 340 deals with over $3 billion of recognized P&L. Probably what's most notable and what we take the greatest degree of confidence in is the very, very low loss ratio that they have associated with that long track record. We would further highlight in terms of potential weaknesses, the fees associated with this offering, tying to being an evergreen fund. What that means is that there is an annual crystallization of the incentive fees, as opposed to in a drawdown structure, which is the typical structure that you see in private debt funds and typically private market funds, where you have the incentive fee be crystallized at the end of the life of the fund. It's one of the trade-offs associated with this type of structure. That said, Tom and team has negotiated a more favorable term and more favorable structure for New Mexico given the size of the relationship. Also, the AllianceBernstein ownership. This was a transaction that occurred in March of 2022. Formerly, CarVal was an employee-owned entity. From a mitigating perspective, we do appreciate that CarVal maintains full investment autonomy, and we appreciate that that Jody is here with us today. She's one of the senior members of the CarVal organization and has full investment autonomy. So with that, I'll turn it over to CarVal.
Thanks, Mary. Awesome. Great. Thank you very much for your comments. On behalf of our team, we want to say thank you very much for the opportunity to present today. And in our time together, we're going to give you a brief overview of AB CarVal and then go into our asset-based budget strategy. With that, I'm going to hand it over to Matt.
Thank you. All right. I think we're on, page 415. We'll get started. So CarVal investors identify very much a focus and expertise in opportunistic credit investing. We employ fundamental value investment philosophy, and for us, over our 37-year history, that means we've gravitated towards credit, real estate, and other real asset situations. The firm today is 200 people in 5 offices around the globe. We're headquartered in Minneapolis. We have a couple of dozen people in New York. We have 60 in London, where we've been really since the early 90s, and that continuing representation and presence in that market is a huge differentiator for us. We'll talk about some investment examples, and you'll see that come out. The firm employs a multi-strategy approach. You see that in those 4 boxes on the right-hand side of the page. This is probably nothing different for a lot of opportunistic credit investors across corporate credit, loan portfolio, structured credit, and hard assets. What we're talking about today is in the loan portfolio space. The origin of the firm 37 years ago was buying loans, and when I say loans, I mean dozens, hundreds, thousands of loans out of the S&L crisis. The RTC put together to clean that up. So the firm's origins are in the space. We've called it loan portfolios for 37 years. The market has begun to call it specially financed or asset-based or asset-backed over the course of the past 5 going on 10 years. But to us, it's the same opportunity set. It's working with financial institutions, providing them liquidity solutions, and that's both relative to buying loans, but also financing loan production for them as well. Jody will get into those examples. So with that said, maybe Jody, I'll turn it over to you to talk a little bit about the asset.
Okay. Yes, thank you all very, very much, and thank you for engaging with us on the fund. We couldn't be more excited about the opportunity set that we have, and so maybe I'll start by just sharing with you a little bit more about the historical experience of the firm in this space and referencing the slides that are labeled overview and our specialty finance capabilities. I've been with the firm for 30 years, and the minute I stepped in the door, we were buying loan portfolios from the banks and lending to non-bank originators of various kinds of loan portfolios. And those were very early days in what we now know as the specialty finance market, and they've grown dramatically over the last few decades. We scaled the business really on the heels of the global financial crisis, where both across the U.S. and European markets, we had a tremendous opportunity to buy any kind of loan portfolio that was out there for sale by all the banks across all the markets and all the asset classes. And that included non-performing exposure and higher quality performing loans. We made a judgment based on our early decades of investing experience to focus on the higher quality performing exposure because we liked the attributes of it. One important element, as Tom and others have referred to, we like the current yield on the portfolios. And when we're buying these loan portfolios or lending against them, they're amortizing and principal is paying back, and that profile is very de-risking. We also like the diversity of the portfolios that we're investing in and lending against, because often there are hundreds, thousands, and even hundreds of thousands of loans in these portfolios that we're investing in. That's really attractive from a diversification perspective, and you don't have the binary risk associated with investments that have just one credit or a small number of credits, which is why our track record is quite strong in this space. The outcomes are a narrower band of outcomes. While the deleveraging and bank retrenchment was happening post the global financial crisis, and the banks were stepping away from some of these lending businesses and exiting the market, the specialty finance or non-bank credit origination market grew dramatically. When they did, because of our history in the space, we were very active and have been active since, both being an off-take counterparty for non-bank originators of consumer, residential, and small balance commercial loans, as they look to have diversified exit channels for the loans that they're originating, and providing financing to them to the extent that they're interested in growing an on-balance sheet portfolio. So these spaces have been very active for us. We think now with the proposed banking regulations that you may have heard of called the Basel III Endgame, this will be a final post-GFC regulatory squeeze on the banks and force the banks to be safer, take less risk, and look to the private markets to take most of that risk on the balance sheet. We've got 70 investment professionals at AB Carvel across our U.S. and European teams focused on specialty finance and the asset-based finance strategy. We've got 32 of those 70 investment professionals. It's very much a focus. It's always been a focus, and so we appreciate your interest in the opportunity set and what it can do for your portfolio. I'll make a few comments here on how we think about investing just from a philosophical perspective and what's important when we're making these kinds of investments, whether it's buying portfolios or lending against them. One of the most important elements is that we think about downside protection first and foremost. So whether we're investing in a portfolio or lending, we're very focused on structural protections and other protective bells and whistles, so that if not everything goes perfectly to plan, we'll still have a acceptable outcome, certainly principal protected or principal protected with some return. We also take an approach, this is consistent for the firm overall, certainly for what we're doing in the specialty finance markets and for the asset-based funds. We have the 32 investment professionals focused on this. A lot of the team is in Europe, some of the team is in the U.S., And the job of that team, including the investment committee, will be to look across all of those markets and asset class opportunities and choose the best ones that will have the best risk-return profile. This is a look at fundamentals across the asset classes and markets. It's a look at originator credit quality and the quality of originating partners that we're working with, and making good judgments about what we put into the fund. That is the essence of it, and that will be very important to value. So maybe I'll just focus a bit on the team page, which is the specialty finance team, and make some comments about those 32 people. 5 of those investment professionals are new to the firm within the last couple of years. The rest of the team has been with the firm for many years, and we've been working on these strategies together as a team. We've got diverse experiences across the members of the team. Some come with a very analytical-based experience. Some are more sourcing-oriented, and some are more legal and contractual-oriented. And getting all of those perspectives and experiences to the table has been very critical to our performance and track record in the space. Diversity is very important to us. I mean, we've certainly focused on that cognitive diversity, but also gender diversity and ethnic diversity, and that has served us well and served the track record as well. So one of the important elements of how the team works together, beyond just relative value and making assessments across those asset classes, is the importance of our behavior, how we face the market, how we are to work with. And just given the nature of the business and the activity and the sourcing, it's very relationship oriented. And so we've got a long track record of engaging with sellers and institutional servicing partners to execute on the business. And you can see some of those long-standing relationships on the slide labeled operating partners and key relationships. And it has been a very important foundation and underpinning to our business for decades. So those are some introductory comments, and I'll just make the comments that our track record in the space is great. We've, since the GFC, invested $10.9 billion in these particular strategies where we're investing in performing high-quality assets, and have generated an 18.3% gross return and a 14.8% net return across hundreds of transactions. So I'll leave it at that, and happy to take any questions.
Thank you for your presentation. Do we have any questions or comments from council members? Hearing none, do we have any other? All right. I'm going to ask Councilmember Bingaman to walk us through a vote so that we can affirm or not action based on this presentation and proposal.
Thank you, Governor. Based on the recommendations of the Council Investment Committee, Private Debt Advisor Makita, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $200 million to AB Carval ABF LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Great, we have a second. I heard that. I think that was from Member Summer. We need questions, comments, concerns. All right, hearing none. Let's call for a vote on the matter before us. All those in favor say aye.
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 Any opposed? Hearing no opposition, the recommendation is approved. And thank you very much for your time and attention today. Thank you.
Thank you.
All All right, we are now on agenda item number 4, and we're gonna get, some information, or informational reports. It's a bit redundant, but okay. And, Mr. Shipp, we'll go to you. My agenda says, we get a vote on any of your, are you making a recommendation? Fine, all right.
No, ma'am.
This is for informational purposes.
Sure. And it shouldn't take more than 3 minutes, Governor, thank you. I just wanted to point out, and I'm on page 425, as I typically do, I included a budget schedule as well as the investment holdings report, both for May. This is just a reminder, one more month, the month we're in is June. It is the end of the fiscal year. We have a lot of deadlines we're working to meet, and this is the time of year where the accounting area, not that they're not usually really busy, but we really pick up our pace a little bit. We're closing out one year, fiscal year 24. We're rolling into a new year, fiscal year 25, and then shortly we'll be doing an appropriation request for fiscal year 26. So we'll have 3 years kind of up and running at the same time, and it's quite a challenge. Just wanted to remind everybody of that. And then I think on the third item here, agreed upon procedures report for the third quarter. I did receive that I think it was yesterday actually. I will be forwarding that out. It has a deadline of June 30th. The auditors have already provided that to me. On the investment holdings report for this month, you will note on page 431, or actually 443, there's a new fund, the Higher Education Trust Fund. It was funded by the transfer from the Tax Stabilization Reserve Fund of $959 million. So if you look at that new fund and want to know where it came from, it's due to a transfer from the Tax Stabilization Reserve Fund of a like amount. And so if you were to go back for the Tax Stabilization Reserve Fund and compare it to prior month's report, you'll note that that has substantially declined over the prior month. And then I did want to highlight, if I may, the Capital Development Fund. We are waiting for funding on that. I think we've been in communication with both DFA and the Board of Finance, and we're expecting $475 million toward the end of this fiscal year, which is going to be in the next several days. So just be aware that for June we will have that fund. And then for July 1, we are expecting funding from the Workforce Development Fund. I think we discussed that briefly earlier. And then right away we're going to have a distribution on that for the funding for fiscal year 25. Other than that, Governor, unless there's questions anybody has, that's all I have.
And any questions from any of the council members on our informational status report? Thank you very much, Mr. Shipp. Anyone? All right, thank you. Seeing none, hearing none, we will move on to that next matter of business. We are at the closing section before public comment. And do we have any members who have any issues or concerns about old or new business? All right, then I'm going to announce the next State Investment Council meeting, which is Tuesday, August 27, 2024, right here. Tuesday, August 27, and I look forward to seeing more of you around the table. And thank you very much for everyone participating in any way that you can. We are now on item 6, which is the public comment period. Do we have anyone either here?
Chair, no public comments.
Okay, thank you, Mr. Woolman. With that, I would entertain then a motion to adjourn the State Investment Council meeting. So we've got Member O'Donnell. We have a second? We've got a second by Secretary Propp. All those in favor say aye. Aye. Aye.
Aye.
Any opposed? Hearing none, motion carries. The meeting is now adjourned.